ABSD deadline extended for large en bloc sites, the threshold falling to 65% for older condos, and possibly en bloc reforms that could bring aging condos back into the market. There were multiple government moves in the past week. If you are a condo owner in Singapore, you'll probably be wondering the same question: is the en bloc fever back? To answer this question, I dive deep into the history to understand the inner workings of an en bloc, and most importantly, the numbers that drives a successful deal. And I've built an app over here where you simply have to key in a condo name, it populates all the available information, and with a few educated assumptions, come up with the condo's en bloc potential. So let's go. Hi everyone, my name is William from Own This Property and welcome back to the channel. Now here's the flow for today's video. We'll start off with an en bloc history, understanding the past fever periods, the boom, the bust, and where we are at today. And second, en bloc 101, giving you some basic information about how an en bloc actually works. And number 3, I'll be running through with you 5 case study of real world condos in Singapore using the en bloc calculator I've built. And lastly, answering the most important question: what does all this mean for you and whether the en bloc fever is really back? As always, what I'm about to share with you are my own work and calculations, so always please do your due diligence. So first up, the history of an en bloc cycle, and we go all the way back to 2005 to 2007, the boom. And this was a macro-driven boom because the economy was rebounding from very severe recessions. We had 3 recessions, starting from the 1997 Asian financial crisis, then you had the 2000 dot-com bust, and then you got 2003 SARS outbreak. So by 2005, the inventories in Singapore were essentially depleted. The economy was rebounding strongly. GDP grew about 7%, and that sparked a lot of renewed confidence. And the additional kicker was that there was this 1998 master plan change, and in that new master plan, they actually released what we know now today as the gross plot ratio. So the gross plot ratio GPR system was introduced, and essentially developers now have a systematic way to see that condos actually can 2 times or 3 times the allowable GFA. After that significant run-up, we had the 2008 collapse, and this was driven by the global financial crisis. In this period, the property market was not spared, just like the Singapore economy, but the property price index actually fell by more than 20%. So developers became very risk averse, buyer demand plummeted, and the liquidity crisis also add to the trouble of financing new properties. So in addition, there were actually stricter en bloc rules, because don't forget that just about 3 years ago, there were a lot of disputes stemming from the slew of en bloc that happened. And after kind of like a lull period, we entered the 2017 and 2018 en bloc fever. Now, after very strong sales between 2013 to 2016, again, developers were starved of land. The unsold inventory actually dropped to a multi-year low, just about 19,000 units, compared to about 40,000 units if you were to look at maybe 2011 to 2012. So there's a lot of competition as well. There were a lot of big foreign players, mainly from China, entering the market. They had huge capital and they started bidding very aggressively for land, and that created a new cycle and the en bloc fever. Now this time, unlike the previous fever, the collapse wasn't due to a global financial crisis, but this time the government actually intervened. So 2018 was the kill switch. Our authorities came in to tighten the market significantly. So before this, developers had to pay 15% ABSD on the land, but it's fully remittable once they sell every single unit. But from July 2018 onwards, the cooling measure increased this to 25%, and there was another 5% that is not remittable. So essentially, it's a tax on the developers. And in 2021, this was tightened further. ABSD increased to 35% on the developers. So that definitely killed the developer side. But on the buyer side, loan-to-value ratios will also decrease by 5%. So overnight, the developers' profit margin shrank because they can't give high premiums to the owners anymore. The owners were not enticed, and no en bloc happened. And taking it one step further, I dive deeper into the research and we overlay some of the biggest deals that happened during these few periods, and we calculate the premium that the developer paid over the existing resale prices. And you can see from the previous 2 fevers, right? For example, in 2007, we have Farrer Court, which is Linden today, and then you have Linden Heights, which is Linden Residences. So owners roughly got a very high premium. In this chart, you can see that they got around 80 to 100% above their resale value. And then in 2017's fever period, this were mostly your ex-HUDC estates like Eunos View, which became Park Esta, Tampines Court, which became Treasure at Tampines, but the owners still walked away with very, very good premiums, 75% to 85% above the resale. So that's real en bloc fever in the sense everybody was getting massive payouts. But after the slew of cooling measures, the developers' profit margins were compressed and owners were still pretty sticky on what they thought their development would be worth in an en bloc. But the reality is that that's not the case. Trump Park, for example, eventually landed in the current range that we are in. So this current era, this range, you have between 20 to 40% premium above resale for the owners. So this band also kind of lines up very perfectly with the overall long run average. This was based on an NUS study that studied en blocs from 1995 all the way to 2018. The average stood at about 37%. So in our current era, I think it is the ABSD on the developers that is putting a stop on en bloc activity. But then, surprise, surprise, past few weeks came some easing measures. For the first time since 2018, the government is finally easing the developer side cooling measures. This is a clear demonstration again, I think, that measures can be tightened when the market is very strong or overheating, but measures can also be loosened when the market is weak. And that's exactly what we are seeing. And not only in the private developer side over here, but if you saw the news, the 15-month wait-out period also started to boost HDB demand after 2 quarters of declines. So the first move that they did was here, ABSD remission timeline is now extended. Last time, standard was 5 years to build and sell every single unit. If you miss by just 1 unit, the whole 35% gets clawed back. 6 years for large sites, this is between 700 to about 1,399 homes. 7 years for mega sites, and these are sites with 1,400 units or more. And the mega sites just need to be about 50% sold at the end of 6 years. The second move, and this is more still in the proposal stage, but essentially it aims to cut the consent threshold for older estates. So today it's 80% for anything above 10 years old, but the proposal further splits it into buckets. So 10 to 39 years, you still stick to 80%, but if your estate is 40 to 59 years old, it drops to 70%, and 60 years and above, it drops to 65%. Now, this does not mean that en bloc become easier because the proposal also tightens the safeguards. You need 35% support just to convene the meeting that kicks off the en bloc, and the committee gets 6 months instead of 12 months to collect the signature. And whenever a failed attempt happens, the lock period is not 2 years, it is now 3 years. And the summary is that if you think about it this way, it is now easier to cross the finish line, but it's harder to get to the starting line, and it's more painful if you fail. Which developments became more attractive? I created a watch list of condos ranging from 40 to 59 years old, and I attached it into my en bloc calculator over here. If you are keen to find out what are these developments in the watch list, you can reach out to me on WhatsApp and comment en bloc, and I'll be happy to share more with you. But before you get too excited, whether an en bloc succeeds isn't just down to friendlier rules. You still have to understand the inner workings of an en bloc, which is my next segment. We'll run through a crash course about en bloc and the math behind it. So, en bloc 101, a collective sale is when all the owners band together to try to sell it to a developer. Now, the owners will form a collective sale committee. They set a reserve price, and this is the minimum that they will accept. And estates more than 10 years old, you will have to get 80% consent by share value and strata area before the site can even go for tender. And of course, the recent rule has changed it up, 75% for older condos. Which brings me to the app that I built. Calculating en bloc potential is not easy. There's no kind of like a textbook answer for it. So this is something that I've done myself through research and my own assessment. And you might come across agents who tell you like, wow, this development got en bloc potential, but how do you actually really quantify en bloc potential? Because sometimes, and I'll show you later in our case studies, the math just doesn't make sense for an en bloc to happen. So to determine potential, we will step into the shoes of the owners and the developers. First up, the owner's perspective, and the owner's incentive is essentially if the developer were to pay today's market land rate, what would be the average owner walking away with on a PSF basis, and whether that is enough of a premium over just selling your unit at the resale market or convincing 80% of all your neighbors who actually signed the agreement. Based on over 20 years of en bloc deals, my calculator grades it into 3 bands. So below 20% premium over resale, these are generally just low chances of that happening because that almost never wins consents. Now between 20 to 40%, this is kind of like the medium range. Deals do actually happen over here, but it is a slow grind because we also realize that a lot of the deals are multiple attempts before they fall within this range. And 40% of more, this is deemed as high probability because that's genuinely very good money for the owners. So the price owner set is called the reserve price, but this is not the land cost that the developer is paying because on top of the reserve, the developer has to pay 2 key charges. Now those are to the government, and the first is called the land betterment charge. This is the fee for intensifying the land for building more than what the site has already kind of like paid for. Now the second is the lease top up. So essentially if you are a 99-year condo, you have to top up the lease whole site back to a fresh 99 years. So the developer's true land cost is your reserve price plus your land betterment charge plus the lease top up. And you divide that by the buildable floor area to get the all-in land rate. And this is what is often you see in the news, quoted as PSF PPR. So that's the number that we will be using because it's the most comparable number. You can use it to compare to government land sales as well. And this determines the developer's feasibility. So let's do a real run through looking at owner's incentive and developer's feasibility to determine en bloc potential. And the case study is none other than Thomson View. Thomson View will be launched as Thomson Reserve very soon in October, and if you haven't seen my analysis of all the new launches coming up in the second half of 2026, you can click on the link above to check that video out. So let's first open up the calculator and imagine we're starting from scratch, right? So we can key in the condo name, we can search, and then we can pull the URA data, and essentially it pulls majority of the information that we need to calculate an en bloc potential, key things like your tenure, your plot ratio, your site area. But there are 2 things over here that I have to point out. They are actually assumptions because these are not publicly available. The first would be the baseline number, and the second would be the strata area. So usually only the sales committee, the management committee would know these numbers. And of course, you can actually buy the reports, but it will cost up to a few $1,000s to get these numbers. So going back now to, let's say we use the Thomson View example. What actually happened for Thomson View? Step 1, what can be built on the site? So the first most important thing the developer will ask, okay, you can actually build up the potential GFA of this. There's all this bonus GFA of about 7%. And this is the total, about 1.1 million square feet. The second thing to check is what the owners will receive, and this is the thing that will go into our owner incentive metric, right? So the reserve price, it happened at $810 million. We divide that by the existing strata area, and again, this is the number that we don't have until it's made public, and you have the average payout for about $1,344 per square feet. Now, step 3 is to then calculate the developer's perspective. We have to find out the enhancement cost. So there's something called the land betterment charge. And there is another assumption that if it's not made public, we won't really know the actual baseline. But for my calculator, we can actually reference the historical cases to get a rough, pretty accurate number, I would say. So the total LBC payable is about $220 billion. And we also have a lease top-up premium. Now we are topping up 49 to 99 years. And in our calculator, we have also already baked in this calculation. And the total enhancement cost for Thomson Reserve works up to $524 million. Now, lastly, what the land actually costs to the developer is after you have the reserve price, we add the total enhancement cost, and that comes to the total land price, $1,330 million. And this would then be the implied land rate that we can use to compare with the surrounding land sales to come up with the developer feasibility. Once we have all these numbers and all this information, what is the verdict? The verdict is medium for Thomson View. Actually, it wasn't high. So on one hand, the owner incentive actually is the one that is pulling down the en bloc potential back then, because don't forget that the reserve price was lowered from 918 million to 810 million. And that's why you can see that the owner incentive then ended up in the lower end of the medium range. But developer feasibility was great. They got the land at a very good price. And obviously the land is very huge, a lot of potential. So if we combine these 2 key metrics, we end up with a medium potential for Thomson View. The second case study will be the very recent Loyang Valley. This happened in April, $800 million to Singai, which is the biggest deal since Thomson View. Now, the owner's average payout is about $1,405 per square feet. This is a 39% premium over the resale, which is at the upper end of the medium range. While from a developer's perspective, they certainly got a good price, all in just about $939, so high developer feasibility. So overall, the verdict came up to high, which is exactly what happened for this en bloc. And before you assume that a big payout would then lead to an en bloc happening, but let me show you where the trap is. So in 2023, EuroAsia Park asked $500 million. So on paper, a payout of over $2,100 per square feet, which was much higher than the average resale over there. But at the other end of the deal, it implies a land rate of about $1,558 per square foot PPR. When you use the comparable land, they're only going for around $1,200 to $1,300. So no developer will be paying 19% above the market, and then the tender expectedly closed with 0 bids. The calculator rightfully deemed it as low potential. Quick pause, because if you're watching, you'll probably be wondering whether your condo, especially if it's older than 40 years old, has low, medium, or high en bloc potential. So if you're keen, you can reach out to me on WhatsApp. Let me know the name of your condo, and I'll run it through the calculator to see what the answer is. Let's finally test out my calculator's predictive capabilities with two actual en blocs happening right now. This is Pine Grove and Lakeside Towers. Pine Grove is an ex-HUDC. You see a common trend here, right? So these are massive developments, 660 units on a massive plot of land off Ulu Pandan with 57 years left on the lease. Now, this estate has been trying to en bloc since 2008. The fourth attempt, the reserve price of 1.95 billion, had no takers. So now it's attempt number 5. They have actually lowered to 1.78 billion because they know that they have priced themselves out previously. So remember that we want not only the owner's incentive to be high, but the developer's feasibility to be good as well. Lakeside Towers, now this is a smaller development, 144 units, it's 45 years old, next to Jurong Lake Gardens, and this is the third attempt after it last failed in 2018. And in 2023, it was also left behind because the two neighboring plots successfully en bloc, and they are now known as Lake Garden Residences and Sora. Disclaimer again that these are my own estimates. The calculator is missing two key variables that are not made known to the public. This is the existing strata area and also the baseline, which impacts your land betterment charge. And according to my calculator, drumroll please, Pine Grove has a high potential to en bloc successfully because both the owner incentive and the developer feasibility are in the high range. Whereas for Lakeside Towers, the owner incentive is good in the medium-high range, but unfortunately, the developer feasibility is kind of like medium-low. So overall, it's rated as medium. And this is exactly what I advise a YouTuber who reached out to me. I run her condo through the calculator, and the result came in around the low to medium range. Now, this doesn't mean that it will not happen, but we have to add another nuance onto the analysis, because her development is even larger than Pine Grove. If Pine Grove is already about 1.78 billion, that means that this plot is easily 2 to 3 billion dollars. Just the tax alone on this development, a developer would very unlikely want to bid so high or so much for this land, because the tax alone, they can just go and do and develop and buy a land for a normal GLS. If we add the nuance over here, while the new ruling targeted specifically large mega sites, I do think that mega developments are actually the biggest hurdle for en blocs, not because the consent can't be reached, but because the developers don't find it feasible. And finally, to wrap this up, what does this mean for you? What does this mean for the market? And is the en bloc fever really back? You might think that in the news, you have a lot of en bloc activity happening. Your condo itself might also be starting the whole process, but nothing has changed significantly because the key thing that actually prevented en bloc from happening was the ABSD 35% for the developers. And this kind of created a permanent cap to the payouts to the owners. So it's getting harder and harder for owners to be incentivized, and it's also getting less and less feasible for the developers because they have to pay a huge amount upfront first. So where does this land us? I think that right now we are in a selective window. We have reasonable premiums, payout of 20 to 40%, developers being able to get land at or maybe slightly below GLS rates, And finally, the two easing measures that kind of give it a slight booster for sales to proceed. And if we really understand how policy works and why the government did this, take a look at the GRS trend. So in this chart, you can see that since it peaked in 2024, the government has been slowly reducing the pace of GRS. So in order to keep a well-balanced market, which is what everybody wants, right? You want to prevent any demand or supply gaps. So we want strong and stable growth. Since GRS has fallen and is likely to fall further in 2027, the potential en bloc supply coming in can kind of offset this decline and balance out the supply side. And lastly, what will happen to prices? This is what I call the en bloc liquidity and wealth recycling loop. It kind of creates a self-reinforcing market force that is positive for price growth. If you take a look over here, when the en bloc gets approved, the owners essentially get about 20 to 40% premiums above the resale. Now, these owners are then displaced, they don't have a home, but on the other hand, they also receive multi-million-dollar payouts in cash. So they want to use this money to re-enter the market. And this re-entry is almost immediate, right? Essentially, a lot of these people actually lost their homes. So they will then re-enter the market, be it resale or new launch. They will want to replace their home. And because they got so much money and they need a home fast, that means that they are more immune to higher prices. So all this causes the price to increase, and it creates greater confidence on the consumer side as well as the developer side. Developers see that their sales has been very brisk, and then they go and en bloc the next one, and then the cycle kind of repeats. If you are in an aging condo and wondering whether your condo has en bloc potential, you can reach out to me on WhatsApp. I'll be happy to share with you the different paths that you can take, whether you should wait patiently or whether you should just let it go. Using the calculator, run through your condo to determine the true en bloc potential so that you can make the most informed decision. Thank you so much once again. Don't forget to like the video, subscribe to the channel, and I'll see you in the next video.